Avoid emotional decision-making. Emotions like fear and greed can lead to impulsive decisions. Stick to your investment plan and avoid making rash moves in response to market volatility. Have an exit strategy. Know when to sell. Establish clear criteria for when you'll sell a stock, whether it's based on reaching a target price, changes in the company's fundamentals, or changes in your financial goals. Reinvest dividends. If you invest in dividend-paying stocks, consider reinvesting the dividends to benefit from compounding over time. Regularly review your portfolio. Periodically assess your portfolio's performance and make adjustments as needed to ensure it aligns with your goals and risk tolerance. Seek professional advice. If you're uncertain or uncomfortable with managing your investments, consider consulting a financial advisor or planner for guidance. Stay disciplined. Investing can be a long and sometimes bumpy road. Stick to your plan and avoid making impulsive decisions based on short-term market fluctuations. Monitor tax implications. Be aware of the tax consequences of your investments. Strategies like tax loss harvesting can help you minimize taxes. Remember that investing in stocks carries inherent risks, and there are no guarantees of returns. It's important to make decisions based on your individual financial situation, goals, and risk tolerance. Consider starting with a diversified portfolio and gradually building your knowledge and experience in the stock market over time.